Hello, you're very welcome to podcast 325. We're running the night shift here in Informed Decisions HQ podcast, bringing it to you. And this week, a topic that I've been looking very closely at for probably a month or so now, is U.S. equity market warnings, specifically. And what we can do about it as long-term investors. And should we do anything about it? And if so, and if one decided to do something, what their options are. I will explain all. But thank you very much indeed for joining me. It's a really, really interesting one. There's more and more commentators, some with vested interests, obviously, some with positive intent, but some with vested interest, ultimately, shouting from the rooftops about potential US overheating. Some suggest that the massive growth of North American stock, and indeed the S&P 500, ultimately the values and the earnings, although not many are mentioning the earnings, which we'll come to, over the past few years, points to a potential sharp correction or decline in the coming years. Yes, many are predicting a decline, and we know how predictions tend to work out in this world. But anyway, I'm trying to share a balanced piece around the main claims, ultimately, that I've taken the liberty of summarizing. And the first one is that US tech stocks have gone so incredibly well for several years. These companies and the S&P 500 as an entity is now overpriced and make up a larger proportion of global market than they should. All right. That's the first claim. As I said, we'll look at each of these individually. The second claim is that the future expected returns from the S&P 500 as a whole, which makes up now a reasonably large portion of the vast majority of global equity investors' portfolios, the future expected returns from the S&P 500 is grim, is the projection, and therefore people should reallocate to Europe, emerging markets, and other locations in pursuit of returns, ultimately. So they're the claims, they're the alarms being rung by some, right? And this is not by all, but by some. And so I'm going to share the data and where they're coming from with this rationale. I typically don't comment or share my views on the current market, but I think this is a really interesting one because it's getting quite a lot of coverage, and there are people that are saying, "Oh God, run for the hills." Okay, so I'm going to share where they're coming from in terms of data and what data they're using to make these claims, my views on it, and ultimately what one's options are if they did want to take some action. All right. That's what I'm going to share. So it's quite the piece. It was quite a bit of putting together and sharing this piece. So I hope it's of value to you. Right. And for information purposes, I'm not trying to make predictions about markets, etc., as you know. Ultimately, my view is that well-diversified investors might not need to think at all about this. Less well-diversified investors might want to think about all of this. Only time will actually tell. But as I said, I'll explore what is and isn't actually happening and what the options are. First thing I will say is that nobody knows if Europe, US, or some other area of the rest of the world will perform better or worse this year in 2025 or next year or any series of years into the future. Nobody actually knows, right? So while the data can be presented in such a way to point to a potential outcome, the actual future outcome is unknowable by anyone. All right. So again, it's about being diversified ultimately. The second thing I would say is that I certainly don't know if Europe, US, or some other area of the world will perform better or worse. And that points to why I always suggest from day one of an investment is that we are as well diversified as we can be while maintaining a position that will enable growth when and where growth occurs, wherever in the world that may be. So that's my opening and closing gambit, as it were. So, but having said that, let's look at what's being said, okay? And there's three things that I have observed which make me think that there may be a shift in how well people diversify their investments globally. So the first thing is that US tech and the S&P 500 have gone gangbusters relative to the rest of the world, right? If you're on the blog, uninformeddecisions.ie, you'll see the charts. That's probably the easiest way to see the charts as we're going through it. Anyone that is paying attention to markets will know that the S&P 500, never mind the tech aspects of the S&P 500, have done incredibly well versus the rest of the world over recent years, which is what we're really talking about and focusing on here, right? But how much better? Well, allow me to illustrate, dear listener. Since 2021, so Q1 2021, so 4 years ultimately, the S&P 500, denoted by a Vanguard Euro accumulating UCITS fund here, has increased in value by 86% in the past 4 years. So Feb 21 to Feb 2025. The rest of the world, okay, denoted by an iShares MSCI X US ETF in euro, has increased in value only 27% in the past 4 years. So the S&P 500 has delivered almost 60% more return in the last 4 years than the rest of the world. That's an incredible number. Incredible. So that settles that. The S&P 500 has done incredibly well compared to the rest of the world in recent years. No question about that. Okay. And this growth of the US market appears to have been driven by a relatively small group of stocks. All bar one are the giant technology companies: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. This group of shares, or stocks rather, commonly referred to as the Magnificent Seven. They have generated the majority of the returns in the S&P 500 in recent years, as you'll hear more about in a moment. But their outperformance and their disproportionate growth ultimately has been so large that the market is concentrated. The S&P 500 is concentrated at a level not seen apparently for a century, according to Goldman Sachs Asset Management 2025 Outlook, which if you Google, you can find the PDF of that. Goldman Sachs Asset Management 2025 Outlook. And so going back to 1930 approximately, before we've seen such concentration, right, in terms of the top 10, okay? And it's up at close to 38% right now. All right. So that's the S&P. So the top 10 holdings account for almost 40% of the S&P 500. That's what we're talking about in terms of that concentration. And that's largely led by the tech companies. Okay. The Magnificent Seven there. No question. So that's an interesting one, right? So you're seeing that and we're reading about this and that's saying, right, wow, everything has been extremely good. That because something has been extremely good doesn't necessarily mean that it's all of a sudden going to become extremely bad. And that's an important point to make here. All right. Another thing that another person, I guess, ultimately that I watch and listen to is Callum Thomas from Top Down Charts. Now, he is an economist. Again, he does not have a crystal ball, but he puts out some really interesting data and research. So that's CALLUM Thomas Top Down Charts if you want to check him out. Now, you can subscribe to him and pay a fee to get the bells and whistles, but he does share some interesting stuff to subscribers on a free subscription. But he sees a bull market in Europe, right? Now, is he right or wrong? Who knows? But again, it's just pointing to this fact that, has US had its day? This kind of narrative is really knocking around, right? Is Europe the new place to be? And you can see hints of that. You can see sprinklings of headlines in American news. You can see it in European news. There's this kind of sentiment shift towards Europe being the new US, right? For want of a better expression. So Callum Thomas, again, he shares some real data. He talks about a couple of things, right? Ultimately, valuations. And he's talking about Europe here, but also the rest of the world outside US as being a potential place to consider in the short term, at least. Valuations, he talks about, right? Unlike expensive US stocks, Thomas suggests European stocks are still cheap or reasonably priced and trade at a record low valuation discount versus the US. He talks about monetary policy. The European Central Bank began rate cuts earlier, June 2024, than the Fed, and cut by larger amounts, right, from 4.5 to 2.9. A tailwind for the economy and markets is how he put it. He talks about geopolitics. He believes the Russia-Ukraine conflict is going to be put on hold soon and potentially, he says, hopefully lasting peace there, which will remove war-related costs and decrease uncertainty, and maybe even, he goes as far as to say, help Europe's economy through rebuilding. Politics, he talks about Germany is looking likely to see a shift in government from left to right, which will likely see a more growth, business-friendly regime. He reckons that this will be good for the rest of Europe and as its largest economy accelerates. He talks about China then as well. He suggests that China's economy, which has gone really well over the last year, is starting to turn up from recession and prolonged property market downturn, and this would be a boost for Europe's luxury goods companies and wider export demand. So he goes as far as to say that these points are medium longer term and that it looks like the rally and the breakout in European equities, which we've seen since the start of this year, is a sign of more to come, right? So is it a souring of the US and a more favorable view of Europe is what we're kind of seeing from America, all right? So if that's the case, and if American investors start piling in and there's investment over this side, maybe that would get some momentum going, right? Maybe. Who knows? Maybe, right? We don't know. And then another one, a more closer to home one, this one. But Ross Cohen, Cohen, is a financial planner with Ritholtz Wealth Management in the US. And they're the celebrity superstars of financial planning in North America, guided by Josh Brown, Michael Batnick, the guys on the Compound and Friends podcast and Animal Spirits podcast. They're everywhere in America. He's on CNBC or whatever Josh is on every day. And they're really the hip, if that's the right word, the hip financial planners in America. And Ross works with them. I met Ross a few years ago and I've kept in touch with Ross, but he's a super guy. He shared a post on LinkedIn, which I was amused by, but it highlighted how in vogue European investing and the rest of the world investing is outside of the US so far in the last 12 months. Many American investors and advisors typically just invest in US only. Like they just buy and hold the S&P 500 and to hell with everything else. They don't look outside of it. But Ross's post highlighted to me that, maybe even people like that are starting to look to the rest of the world for potential returns. The US is noticing the rest of the world ultimately from a returns and investment perspective. And Ross's post, which I have on the blog, it states ultimately that the past 1 year equity performance by country saw the US in third at only 23%, whereas China and Germany were ahead of it with 32 and 26% respectively. I commented, thanks for noticing the rest of the world, Ross. And he said, maybe I should include Ireland to that chart. I didn't have the stomach to tell him, look, you needn't bother. The Isaac Index has been an absolute basket case. But I loved his intent. But Ross is a really good guy. Ross, Cohen on LinkedIn, if you want to follow him. He shares some very interesting ideas. So those three things ultimately, and many, many others, but those three are the primary ones that I recall when I sat down to look at this. What's changing, right? So there's the US are starting to notice the rest of the world. There's potentially a very strong case for Europe having a reasonable rally. And there's that whole narrative of, well, look at Jesus, the US has gone so well, it couldn't possibly keep going, which of course it could, all right? But they're the three things that are knocking around, okay? The US has been exceptional. The tech stock has been exceptional within the S&P 500. As we saw, 60% more returns than the rest of the world over the last 4 years. Unquestionable. But going back to those earlier warnings that I said are being flagged, the second half of the first warning is that the S&P 500 is overpriced and makes up a larger proportion of any globally diversified fund than it should. So this is quite opinion-based. In reality, I'll share the stats with you, but it's quite opinion-based as whether something is over this or over that. In 2024, more than half the S&P 500's 25% return came from the Magnificent Seven, right? We've spoken about how amazing they have been. NVIDIA alone, with its 171.2% return, produced more than 1/5 of the entire market's gain in 2024. If you were invested in the S&P 500, 20% approximately of your money is in the top three holdings of Apple, NVIDIA, and Microsoft. The same three stocks now account not quite 20, but for 13% of an MSCI World Index, which is a lot. That's the point. That's the point that is being made. The top 10 holdings account for 36% in the S&P and 25% in the MSCI World Index. So if you just bought the MSCI, you were trying to be globally diversified. The point here is that, well, you are and you aren't, because there's this concentration at the top. There's a concentration at the top because those top ones have done so well. All right. That is the point that people are making. Okay. And where they're getting this basis for, it's more than it should be. Who knows? But such dominance by a handful of companies isn't unusual. Jason Zweig, Zweig, who writes, he's a journalist and a personal finance writer, ultimately, I think, with the Wall Street Journal. Really great. Writes some very, very interesting pieces. He wrote recently about the fact that going back 200 years in 1812, the insurance and bank sector, so the financial sector of the S&P 500 of the North American market, made up 70% of it. So just the financials made up 70%. Now the financials make up approximately 13%. But yet, had you just held the S&P 500 for that period of time, even though there was that cataclysmic shift, all right, reordering, which always happens, you would be on the pig's back, right? You've achieved returns of, on average, over 10, 11%, right? You don't care. The index is just doing all that for you. You don't need to worry about it, right? But the point is that dominance of a couple of companies or a particular sector is not unheard of, all right? Nobody with much credibility out there is claiming that the rise of the Magnificent Seven is a rerun or a prediction that we're going to have a rerun of what happened at the turn of the millennium, when the technology sector drove stock markets upwards, only to be followed by, again, sorry to use the word, a cataclysmic collapse. Nobody is saying that we're on for a repeat of that. The companies in question today are mostly profitable, with incredible competitive advantages and moats, as Warren Buffett would call it, / monopolies. Their successes and their strengths are well recognized at their current valuations ultimately. And it's easy to forget about earnings, right? So when you hear about, the S&P going here, or the Dow going there, breaking new records, all you're seeing is the index price. You're not hearing or seeing about the earnings. And this is a really important aspect to it all, right? Because ultimately that's what's driving things. If you're talking about the PE ratio, the price earnings ratio, which an awful lot of people quote, and which we're going to get to now in a couple of minutes. And apologies, this is going to be a long piece, right? People are talking about overvaluations. That stuff is overvalued, as we've mentioned, right? That's one of the claims going on here. But if you go back to January 2021, the S&P earnings in January 2021 were $105, all right? And the PE was 35 at the time, which is really high, all right? The S&P earnings in January 2025 were 212, and the PE was 28. So the actual earnings, the income from a holding of the S&P doubled in 4 years. The companies generating that. It wasn't a stock market rally purely based on euphoria and expectation and delusion. The companies generated massively and increased that generation twofold in 4 years. Right? It's not like they're junk and people are just buying it blindly. That's not what's happening in most cases. As a market, that is not what's happening. Right? It's not silly season like you might see in some crypto scams, all right, where people are just euphorically buying in stuff that has no intrinsic value, that has no earnings being generated. All right, this is companies that are producing profit, pumping out earnings, and valuations accordingly. And look at it more granularly. It's late. I'm losing the ability to speak. Let's look at NVIDIA. And I just picked NVIDIA, right? We could have picked any of those stocks, but I just picked NVIDIA, which is the kind of the celeb stock or the meme stock of the last year or so. NVIDIA share price skyrocketed in recent years, obviously, right? But so did its earnings. It's insane. The earnings, it's nuts. But if you think the price has gone bananas, the earnings are incredible. 2 years ago, NVIDIA share price was $20 and its earnings were 20 cents. $20 for a share, 20 cent earnings per share. Fast forward to February 2025, its price has gone from 20 to 138. Hockey stick stuff, right? 7x, right? So you multiplied your initial investment by 7 in that scenario. But the earnings per share have exploded even more. They've gone from 20 cents per share to $2.50 per share, right? It's 12x. Going by PE ratios, it's almost twice as good value as it was in February 2023, 2 years ago. All right. But you don't hear many people saying as much, even though it is, if you're using the same metric by which they're saying, oh, stuff is overvalued. But back to the S&P as a whole, right? The S&P now makes up approximately 70% of a global market index, the MSCI, because of the growth of the companies in the US, is 70% too high? Well, it is what it is. That's the market cap. All right? If you're invested solely in a developed global market fund, for example, you have approximately 70% exposure to the S&P. If that's you, ultimately, should you be nervous? Is the future looking terrible? Is that 70% in the US going to deliver nothing basically for the next 5 or 10 years? Should you take action? Well, let's explore it. And this is the whole idea. This brings us to the second claim, right? From earlier, that the future returns from the S&P are going to be terrible and that you should move investment allocation from the US to Europe and or the rest of the world outside of the US. All right? Should you do that? So even if you're in a global market fund, should you be taking funds out of there and allocating to more to Europe or emerging markets or small cap or bonds or other things? That's ultimately what some people are saying is the right thing to do. Well, let's explore. Again, I have a lovely graph here from JP Morgan, Guide to the Markets. Fabulous. Fabulous. I could have just pasted a few of those charts, and those few charts would have painted thousands of words and saved us all a lot of hours today. But go to Informed Decisions and go to the blog and scroll down to the chart with 6 vertical bars and 6 blue dots and 6 green lines, please. And that is from JP Morgan Guide to the Markets. The data is suggesting that a global index fund on the left, world equity, okay, the average since 1990 forward price earnings ratio, which I'll get to, the average has been around 16. Currently, it's at about 19. So it is expensive. That the US is really expensive. It's way above its, shall we call it, long-term average. That Europe is decent value with just below its long-term average price earnings. That the UK is cheap, right? That emerging markets are cheap. And that China is still really cheap. So it is these metrics, these forward price earnings ratios that people are shouting about and selling from the rooftops ultimately to move your money here and there and everywhere. I won't break into song. To avoid Armageddon, as some are saying, or to capture the upside on the other side of things. But forward price earnings ratio, is that a reliable indicator on which to make these sorts of relatively short-term decisions? Forward price earnings ratio is a stock or overall market valuation metric that compares a company or market's price to its projected future earnings, not its past earnings, its projected future. The calculation, as you'll have gathered, is current share price over estimated future earnings per share, which, again, is kind of unknowable. It's a projection. So this entire thing is a projection. The current forward PE of the S&P 500, to stick to the US analysis right now, is approximately 22. And for context, I looked at in January 2022, all the 22s, but in January 2022, going back just over 3 years ago, the S&P 500 forward PE ratio was the same, give or take. It was 22, right? And since then, how has the market performed? Well, total return since then of the S&P 500 is approximately 58%. Forward PE is not a perfectly reliable gauge on which to make long-term or indeed medium or short-term decisions. If it was, we'd all be multimillionaires. that would be the single metric that would determine success, right? It's like having the lottery ticket. It's not. It is not the lottery ticket. It is not. It's not Back to the Future. What was it? Something almanac. What was that thing that he went back and got, that catalogue with all the results? The almanac? Oh, damn it. You might email me and let me know. Whether the US market is overpriced or overvalued and heading for a correction is a matter of opinion and speculation, really. But the evidence in terms of valuations relative to the past is saying that it's in expensive territory, but it's not predicting Armageddon at all. If the growth in US market is simply a reflection of a very vibrant economy and more profitable, efficient, effective companies, then that shouldn't be a concern. Given the US has always looked a bit more expensive than other markets and yet has always continued to deliver over the longer term. There's really nothing new in that regard. But then someone might retort and say, well, there's more JP Morgan charts, you see, which state that the 10-year subsequent returns for the S&P 500 when forward PE ratio is around 22 is between 0 and 4% annually for the handful of scenarios that the stars have aligned like this. So that is an interesting conversation, all right? And so that's something to be considered. Again, that chart is in the blog. So you can see current level is showing the forward PE ratio and the subsequent 10-year returns. When the forward PE ratio is, say, at 11, the subsequent annual 10-year returns are up on average between 15 and 20% per year. When the forward PE ratio gets up beyond 20, it starts to fall down to single digits and then even negative territory when it gets up to 25, 26. Again, it's an interesting chart, but it's not a definitive indicator either. So this brings us to the culmination after quite an awful lot of talk from me and please God, an awful lot of listening from you. If, and it is a large if, we were potentially facing into a decade of 0 to 4% annual returns per year from US equity, what do you do? If that's your belief, and here, this is the thing, it's a belief, it's an opinion, it's a view. It is not confirmed, right? It is not an outcome, right, that we know. So what are the possible options? If you're a long-term investor who wants to achieve returns, but you think the S&P 500 is on the brink of a lost decade, for want of a better expression, if that's the case, what do you do? Well, do you invest in bonds? It is, I believe, sensible to have an allocation to bonds in the vast majority of scenarios and portfolios. And this is no different at times like these. All right. And again, we're just looking at the S&P 500, which is just one portion. It should be just one portion of the vast majority of portfolios. But should a long-term investor allocate much more heavily to bonds because of what some are seeing in the data? If one is a long-term growth-oriented equity investor, I don't believe so. I don't believe it will serve that. If you have an allocation that you want to try and secure or you want to avoid volatility on, then perhaps. But whip it all out of US equities and stick it on to bonds for the long term, I'm not convinced that is typically in one's interests. What about allocating to China or emerging markets, which some are saying are cheap relative to long-term averages, as we saw earlier on? China and emerging markets represent a very small percentage of the global market cap right now. So if you were to allocate, say, 50%, right? And I'm just throwing out a number there for illustration. 50% of your investments here, let's say your pension, you are essentially saying you know better than the market, that you are betting against the US and you're betting heavily on China and or emerging markets, or the UK for argument's sake, which again is deemed good value by some. That's what you're doing. Is that a bet you want to take? Because that's ultimately what you're doing. I probably wouldn't, for what it's worth. What about withdrawing out to cash? So don't if you're in US, potentially come out, or if you haven't invested yet, hold fire and phase back in once the S&P falls, inverted commas. We wrote before that when markets fall across the globe, the S&P 500 typically falls slightly further than the rest of the world at that time. So is this a wise strategy? I don't believe it will serve too many of us too well, quite frankly. The issue around when to get out of equity, if you're in there already, how much and when to get back into equity, in US in this case, and the psychological nightmare cul-de-sacs and traps and mistakes that can and are made around all of that, fraught with danger and risk you massively underperforming the market over the medium and long term, in summary. Plus, how long are you willing to sit in cash if a market continues to charge ahead, for argument's sake? Which the S&P 500 may or may not do from here, for an example. It's a very, very difficult thing to get right, is my point. The phase in idea, some people do that. If they're not already in, they might say, do you know what? I'm going to do 10% investment every month for the next 10 months, whatever the case may be, potentially. That's a psychological thing as opposed to a scientifically or statistically high probability of success approach. It is a psychological comfort, really. And that's why insurance companies brought it out years ago, to make it easier for people to say, yes, right, I'll go ahead and I'll do the investment. It was a sales aid, ultimately, that made it easier for people, as opposed to it statistically increasing the probability of success, which is really all we should be thinking about, in my view. What about reducing the allocation to US and increase it into Europe, for argument's sake, where, Mr. Thomas suggesting this would make sense because Europe is about to enter into a bull market, or is in one, maybe. Again, you're actively betting against the US and on Europe, which, you're entitled to do if that's what you wanted to do. But again, if and when Europe did continue to outperform, at what stage would you rebalance across to the US? If any of these things inadvertently turn you into an active investment manager, that's ultimately the challenge. And that typically, for 95% of active managers, results in a worse outcome than sticking to the index. Bottom line. Statistically, you have a 1 in 20 chance of beating the index, right? And that's professional investment managers who do this all day, every day, who have a team of researchers pumping data and PE ratios and Schiller ratios at them all day long. So if that's what's going to entertain you, fine, but statistical probability of success is extremely low. Long-term investors, no thank you. Passive investors don't do active investment management. That's the bottom line. What about being diversified from the outset? So as opposed to owning the S&P Or as opposed to owning just a single global equity fund, how about being more diversified from the outset? So how about having a little bit more tilt to Europe, a bit more tilt to emerging markets, a bit tilt to bonds, tilt to China, right? As well as owning a very healthy amount of the main markets of the world. How about that for a novel idea? Well, Bigara, that's my own personal preference. The type of portfolio I prefer and use will contain a tilt, as they say, which is the fancy word of saying a bit of, right? Emerging market, small cap, bonds from the get-go, right? We never own enough of anything to either make a total killing or to be totally killed, right? The likes of Zurich Prisma Max, and I'm just stating this because it's probably the most obvious one and I came across it recently when looking at some research for a client. A very strong track record, right? In comparison to an awful lot of the insurance company products. But then when you look underneath the bonnet, that is because that and ones like it typically hold concentrated holdings of the Magnificent Seven and US stocks. The Zurich Prisma Max right now is about 90% equity and 75% of it is US equity at the end of 2024. All right, so that explains why it's done well, because an awful lot of it is in the S&P, as we saw earlier on, versus the rest of the world has had a rip-roaring time. All right, only time will tell whether that is the right strategy to continue on over the long term or not. The type of portfolio that we prefer, as I said, will have elements of emerging market, small cap, bonds, Europe, UK, the whole world, as well as very significant allocations to those drivers of returns. Aim to be diversified from day one is ultimately what I'm encouraging anyone to do. So if you're starting something, please ensure that it is diversified from day one. That's it. The vast majority of us do not want to become active investment managers, neither on purpose nor as an unintended consequence of listening too closely or reacting too quickly to predictions and siren calls. That's my conclusion. Just as we wouldn't go all in on the US if someone said its PE was cheap, we don't run for the hills if someone says its PE was expensive. And I'd say the same for Europe or emerging markets or anywhere else. We have an allocation to it, a sensible allocation from the get-go to all of the main drivers of return globally. We have the tilts in there. Long-term passive investors are long-term passive investors. But we have to work hard to remain passive. And that's the beauty of it. That's why it works over the long term. Short term, who knows? Nobody. I hope this extremely long solo episode was of value to you. I put it together with clients in mind, and I know, or I hope rather, that it is of value to anyone that might be able to endure listening to the entirety of it or reading the entire blog. So thank you, and I hope it helps. As always, you know what's coming. As always, you're a legend.